everybody. Welcome along to this SWEEP webinar. Very pleased to see you all today. This webinar is all about the role of the finance department in the sustainability transition, improving resilience and boosting ROI, essential topics for all of us, of course. I'm Catherine Nicholson. I am from SWEEP, and we have an expert panel alongside me today to share their experience and insights into these topics. So let me introduce them to you now. We have Marie Rateau, who is Head of Finance Transformation at Chanel. We also have Richard Walters, Senior Manager at BearingPoint, and Julien Denormandie, who is Chief Impact Officer at SWEEP. So hello, and thanks to all three of you for taking part today.
Hello, thank you.
Hello.
We're going to have 30 minutes to take our audience through some of the key issues around this topic. And then we'll have at least 10 minutes at the end to take questions from our audience. Now, you can add your questions to the Q&A box, which you'll find in the menu at the bottom of your screen at any point during the webinar. You don't have to wait until the end of the panel discussion. So if something pops up while we're talking, do pop it in the Q&A box, and we'll come to your questions in that last section there. So let's get started. Marie, Richard, Julien, I'd like to ask a quick fire question to all of you to start. Finance leaders, of course, have to focus on long-term value creation for their organizations. So I want to ask each of you what the most important things are to consider when you're trying to align this with sustainability goals. And Marie, I'd like to come to you first.
Yeah, sure. So I think for me, something really important within the finance function is really much to create that culture of sustainability within the teams. I think we have an essential role within finance to be able to foster that and to help driving that message across the teams.
Wonderful. Richard, let's come to you from your point of view with BearingPoint and all the companies you've worked with.
Yeah, I think the first question to me is, what do we mean by long term? And if I put a time on it, I think about 2050, because of course that's when science tells us that we need to limit global warming to 1.5 degrees. And the Paris Agreement, of course, is providing the backbone to all the regulatory frameworks. And what we do know is when we think about that time frame, is the business landscape is going to be really different from what it is today. There's going to be lots of winners. There's going to be lots of losers. And the ability to win is going to be increasingly linked to a business's ability to respond to climate challenges. So I think the key thing to consider for any business leader is actually, where do I want to be in the future? Do I want to be a winner, or do I want to be a loser? And then it's all around, if I want to be in that winning pot, when I think about financing investments, let's think about that long-term future and the benefits that these investments will deliver.
Excellent. Yeah, always good to take the long view. Julien, I know, and perhaps many of our audience know, here at SWEEP, we work with quite an array of companies across different industries and geographies. So from your conversations with those companies, I'm sure you've got some great ideas about this question.
Yes, sure. Thank you very much, Catherine. To me, when you're speaking about finance leaders, maybe the most important element to consider is clearly how to connect timescales, which is absolutely complex. Because on one hand, you've got the short-term timescales looking for positive ROI. And on the other, you've got the long-term timescales looking for resilience and sustainability. And at SWEEP, we enable companies to connect these timescales thanks to a data-driven approach. And probably the role of the finance department within any companies is both complex and essential, because CFO must be able to make investment decisions based on the short-term ROI and the long-term resilience. And to find out at the end of the day, a kind of well-balanced position. So to me, this ability to gather short-term and long-term is probably the most important element to be considered by finance people.
Well, perhaps to pick up on that, come back to you, Richard. You were talking about taking that long view. What are some of the key aspects of the business case to be looking at when our audience are considering financial investment in sustainability initiatives?
Yeah, thanks, Catherine. I think our experiences as we work with sustainability professionals is that they actually find it difficult to be able to get the finance that's often needed to invest in sustainability investments. And so taking a slightly different approach to the business case, we have found really helps to sort of unlock the value. The key challenge is that the traditional business case, which is very focused on return on investment, benefits, cost, looking for quick returns, isn't really multi-dimensional enough to really be able to get business leaders to approve investments. So we've seen others, and we do take a slightly different approach to it. So, and there's five or six different areas within the business case that we think it will be good to consider going forward. So, the strategic case. So, thinking about whether the investment might actually have an impact on our brand position or our ability to mitigate risks. For example, will the investments help us with supply chain resilience, or will they help us actually to adhere to current or future government or economic policy or regulation that may be coming? We think about the economic case as well. So what are the qualitative and quantifiable benefits of a particular investment, and what might be the different options in order to achieve that, and what's the net present value of those different options, and what's the recommendation based on a sort of balance around cost, benefit and risk. We also think about the commercial case. So this is often if we want to take a particular investment, do we actually need to think about our procurement strategy in a different way, or do we need to think about our business model or our use of business partnerships in a slightly different way than we might do otherwise? There's then, of course, the traditional financial case: how we can fund the investment. Is it affordable? What are the tax implications of that? What are the cash flow implications? But then we know we also need to, once we've invested in something, it then needs to be delivered. So what's the management case? How are we going to drive the change? Where might we use pilots? How will we manage stakeholders? Those kind of things. And then lastly, we link it back to sustainability. So does this help us to achieve our ambition?
Absolutely. And I think, Richard, what you're talking about there in a way is sort of centralizing a collaboration, really, a sort of a network within your own organization, collaboration with all sorts of different functions. Marie, I'd be really interested to know if you have any examples from your work at Chanel of that kind of, collaboration with other business functions to integrate sustainability into your financial planning.
Yes, of course. I think for us, it starts with a very strong collaboration with our sustainability department. We work really much in tandem together. So, finance and sustainability working really much on the strategic aspects, but obviously finance feeding that strategic aspect with data, analytics, KPIs, measures, so that they can really, then we can go together to our other departments and ensure that they're setting up goals and actions within their own departments to be able to meet our sustainability goals as well. So I think that's how it starts. I think the additional collaboration is with all the other parts of the business. We have, obviously, as finance, a privileged position where we are in conversation with every single department, and we really are here to advise as well in terms of how they could drive some sustainability reduction, and that also most likely will also drive reductions in cost as well. So that's probably where that strong collaboration happen within our company.
It's so interesting to see how it works in this real world, real business scenario. I'd like to zoom in a little bit on the idea of return on investment, just such an important thing for everybody to bear in mind, and how to maximize the return on investment of these sustainability projects and programs. It is, of course, vital to be able to measure the ROI, but it's not necessarily obvious, I don't think, which metrics should be tracked. So I'd like to know which ones our panel recommend we should keep an eye on. Marie, if I come back to you.
I think I will go back to what Richard's mentioned a little bit earlier today. I think ROI is one metrics, but it's also difficult sometimes to just get the buying just with these metrics around. I think what we've learned within the business is that sometimes more tangible, easy following KPIs can also do the trick really well to be able to get this information and the fundings behind it. Obviously, cost savings is something important, but it's also the value creation. So we're really looking at that new sales or new value creation that could happen thanks to the sustainability initiatives being taken. And there's also, some of the tricks when we provide data or data analytics. The example is on our business travel. We have provided carbon emissions, but we have also gave an equivalent in the number of flights that the teams should, for example, not do to be able to make the carbon emission target on that business travel.
That's an interesting way around to be looking at it, definitely. I think this all involves quite a lot of creative thinking, doesn't it? Looking into what you're trying to predict. Richard, do you have anything that you want to add to that?
Yeah, I agree with Marie actually, and it should be about sales, it should be about profitability, but I wanted to focus in actually on carbon emissions. I'm a real advocate for businesses to show ambition to achieve their net zero future. It's really easy for me to say that. It's often a lot more difficult in business for people to achieve it, for businesses to achieve it, but ambition sets the tone. And I really think that ambition should come to life by an investment in understanding about at a very granular level the CO2 emissions of the business across all scopes 1, 2, and 3. And I think businesses are often waiting for the regulation to push them to make that step, but I would argue that actually you need to make that step sooner rather than later. Be ahead of the curve, be ahead of your competitors, and have gone through the transformation related to CO2 data capture and reporting ahead of the regulations hitting you. So I would argue that it's very much around carbon emissions, and I think the other key point to this is lots of businesses have set, for example, their SBTI, their short-term, medium-term targets, and getting into granular level emissions really helps businesses to understand how well prepared they are to meet those targets. Again, are they ahead of the curve? Are they behind it? What business decisions and investments can they make in order to get themselves back on the trajectory?
Absolutely. And so many different aspects to be looking at where you might be able to gain that competitive edge. Julien, if I bring you in on this, have you got examples that you could share with us about how sustainability-driven financial initiatives and strategies have helped companies gain a competitive edge in their evolving, very turbulent markets?
I fully agree with Richard and Marie. I think, it's very important to speak about the return on investment, especially when you are speaking about financial department. So it's absolutely crucial to acknowledge the fact that at the end of the day, the return on investment will be positive, especially because if you are not adapting your company to face all the climate change situation, then for sure the impact will be absolutely negative. So on the opposite, the return on investment on the long-term point of view will be absolutely positive. Having said that, what is very difficult, and I come back to what I said earlier, is to find a balanced position between the long-term return on investment with the short-term return on investment. And for sure, we need to convince, or if we want to accelerate, we need to convince all the CEO, all the C-level within the company about the positive impact in terms of return on investment on a short-term basis. And to answer your question, Catherine, we've got some examples. Today at SWIP, we've got more than 300 companies, clients, and we receive many quotes from those companies. Just few examples. You've got some company telling us, okay, we have so many clients asking for additional ESG KPIs in the different requests for proposal, the famous RFP, that we need to adapt. We need to disclose our climate policy, social policy, government policy, because it would be part of the RFP request for proposal decision. Second example, we've got more and more companies telling us, okay, if we want to raise fundings, if we want to discuss with investors, then we have to demonstrate to our investors that we've got the capacity to face the climate change's impacts on a long-term basis, meaning that we need to demonstrate our resilience to these investors. And exactly what Richard said, we have more and more investors with some commitments regarding SBTi target, and to achieve those commitments, they will have to have investees reaching and achieving the SBTi target. And finally, we've got more and more decision makers who are questioning the resilience of their value chain. And this is absolutely crucial. And when you are, especially at the time being, with all the discussion regarding the US and blah, 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 you have more and more decision makers questioning the resilience of their value chain. And it means to take into account all the different nature of risk: climate risk, transition risk, social risk, tariffs risk, and blah, blah, blah. And so this point could be very important to be addressed as well by companies, to be sure that they could face the situation. Having said that, you have here different examples of positive return on investment on a short-term basis, but never forget that at the end of the day, the return on investment will be for sure positive, just because not taking into account the climate change will have a very and clearly and highly negative impact.
Thanks, Julien. Richard, if I can come back to you, just picking up on that point about the investments that we were talking about, and asking about, again, real world examples that you've seen where businesses have improved their profitability through sustainable investments, not just shoring themselves up, but actually improving their profitability.
Yeah, sure. It's a really interesting one, isn't it? I think there's, and I've been looking into this, there's a really strong body of research that links market outperformance with a really strong focus on sustainability through investments. And when we think about outperformance, what do we mean? Well, it could be higher profits, it could be stronger growth, it could actually be access to finance, so cheaper finance, because there's less risk attached to financing a certain business. And there's also a play around the balance sheet. So, less exposure and impacts of depreciation, for example, or asset write-offs on the balance sheet itself. So there's a number of different ways we can think about outperformance. And there's quite a couple of good examples of businesses that have been really successful. So actually, Unilever is one of them. So I think I was looking at some stats that approximately 60% their sustainable brands versus their non-sustainable brands are growing at approximately 60% above the non-sustainable brands. So they're really driving performance into their business. And it's quite a well-known case study, Ørsted, which is a Danish energy company, which completely moved away from sort of coal-intense energy generation about 10 to 12 years ago, really because the costs of doing business were getting increasingly higher for them. And they could see, a future where their brand and business was going to be at risk. And they transitioned very successfully at the time, over a period of time, into clean energy, wind and solar, and also energy storage. And that really helped to shore up and actually drive their profitability. I should say as well, that business has run into some problems of their own right over the last 2 or 3 years, because there's also many other things in the marketplace which impact them. But they went through that transition really well.
It's such a big balancing act, as coming back to what we were saying at the beginning, isn't it? Of course. And I think this brings us on to the subject of building resilience through everything that we're talking about. Julien, something I didn't flag up to our audience at the start of this, and they perhaps know already, is that you are a former government minister in the French government, and you're very closely involved with many of the decision makers at the European and national European level around regulation. We have, of course, seen recently the European Commission's omnibus announcements showing that, yes, regulations can evolve. We also know that the specific impacts of climate change are unpredictable. So with that in mind, how can finance departments, finance leaders assess and mitigate financial risks associated with climate change and also with regulatory shifts, which we've seen can be very unpredictable?
Definitely, this is a very interesting question. When you are working within the finance department, you need to report under different framework, under different regulation, and you've got the responsibility to be sure that your company will report in a proper manner. Meaning that when you are speaking about regulation, for instance, the CSRD or SFDR or anyone else, when you are a CFO, you are working within the financial department, you have to be sure that at the end of the day, your company will report in a proper manner under these regulations. Because if not, you've got some financial penalties, you've got some branding consequences, as Richard said, and so on. So this is a very important part of your job. And I mean, all the different financial departments, they know how to handle with this, just because they have already to report under all the financial regulation. Now they have to move from the financial regulation to the extra financial regulation. But what is very important is when you are speaking about regulation, what's the purpose of the regulation? Is it only a report? I mean, a reporting regulation. In that case, how it's feasible to create value thanks to reporting? Not an easy question. Or is it a way to convince companies to create value by questioning your value chain, by questioning your core business, by questioning how you are going to adapt your way of production on the long term, and so on. And probably what is very important, especially regarding the CSRD and this omnibus regulation, is that, to me, there was a mistake at the first beginning of the regulation. The name of the regulation, CSRD, the R is meaning reporting. The CSRD regulation is much more based on risk assessment, the famous IRO, impact, risk, opportunity. So it's much more based and useful regarding the risk assessment. The financial materiality, for instance, it's only a risk assessment for the companies, because here you have a clear objective for the whole company, especially the CFO, but the whole company, how it's possible to track your impact, to address your risk, and to seize the opportunities. And here you have a very comprehensive and useful regulation. So to me, what's important is to make a report. It's complex, but not so difficult. To seize the opportunity of a regulation, to make a transformation within your company, it's much more complex. And we need never give up the meaning of this regulation. So where we want to go thanks to the regulation. Probably this is very difficult.
It's more complex, but perhaps more interesting
Yeah.
for the company to do it. Marie, I'd like to come back to you off the back of that. I'd like to ask about scenario planning, what role that plays in helping companies adapt to sustainability-related risks.
Sustainability is quite complex to measure. I think we said before, there's different elements and drivers, and therefore sometimes just having a fixed statics really doesn't help to be able to make the right actions and decision for strategy. By talking about the drivers, you could have obviously your emission factors, you could have the different methodology, you could have the different cost. And along with this, you can then make sub-decision within all of these areas within the business. So the scenario planning really helps to showcase the areas that you could make different actions with, and ensuring that you mitigate the risk based on it. So if I take one example, regarding materials could be one of them, how much usage of some materials in some of your products you could have, and that kind of mix of usage of products will have an impact on the overall carbon emissions, and then your decision on your strategies at the balance between, as you say, your sales and growth versus the impact that you have in your overall profitability as well. So for me, it's a key areas in sustainability to have scenario plannings, even more than finance, due to the complexity and the potential permutation, I would say, of the outcome.
Richard, if I could bring you in on this, your experience of this scenario planning and, adapting to sustainability related risks.
Yeah, scenario planning is super important, especially at the really senior level. The role of the board, the role of the CFO on the board is to look 5, 10, 15 years out. What does the business landscape look like, and where do we play and how are we going to get there? And if we think then about risks, there's a fairly well-established framework to think about sustainability-related risks related to adapting to the future. So you have physical risks and transition risks. And, I would argue that all businesses should be considering these and scenario planning what happens if, what do we do about these particular consequences? So physical risks, they could be acute, such as, event-driven risks like a hurricane, for example. Or they could be chronic, long-term change. So this could be drought, changing weather patterns, and the impacts that have on political destabilization or people migration in certain places. And if you think about the impacts maybe from a supply chain resilience perspective, so the physical risks. And then the transition risks, you've got what future policies or legal frameworks are going to be in place that my business actually is going to have to adhere to. What's the cost of that? Will I still be able to trade in the same way? What's the role of technology in the future? Technology will increasingly step into the space to drive solutions. Does it leave my business technology outdated? Can I still play in the same market? Talking about markets, are supply and demand patterns going to shift? And what's the implication of that for my business and my value chain? And then last one is around, we talked about brand earlier, which Julien again mentioned, is around reputation. So there's what will my business still be able to maintain its reputation in the future? Because we know that consumer and customer sentiments related to sustainability are changing. What's the impact going to be on my business?
Thanks, Richard. Let's move on to something that's more or less our wheelhouse, I think we could say here at Sweep, but how to leverage technology in this story. And perhaps, Mary, if I come back to you, you've obviously gone through this process of considering what digital tools should I and the finance teams be using, and what functionalities should we be looking to use in order to do this effective tracking and reporting of sustainability data.
So I think in terms of functionality, one of the key aspects that we have, first, we are very much thinking about our teams and our people as well. So one of the aspects was a really easy to input tools to enter the data, more from an efficiency perspective, but also to make sure there is accuracy, and then we can report as well in a timely manner, because that's very important to also meet all deadlines and all requirements. The scenario planning is something I want to come back to as well on the previous question. This is something that is a functionality that was very looked when I'm selecting a tool. Forecasting, so we do report a lot on our actual datas, and that's very important because there is still work on accuracy, on ensuring those measures are correct, and we are auditing against it. But that forecasting element is very important to be able to drive the strategy, to drive the decision, to see which areas we could have an impact on reductions as well. And I would say the last one is the visualization. It's well and say to have some numbers, but if we can't share it and ensure that people know about it and how to then action against it, it wouldn't be very valuable. So that visualization part is also very important.
Absolutely. As you say, it's often not the data so much necessarily as how it's communicated. Are you communicating it to a specific department or function in a way that makes it relate to them? And are you able to do that via your technical tools? Richard, when we spoke before, you said that you had a couple of real world examples that you wanted to share with us.
Yeah, absolutely. And just before I do that, I just wanted to touch on some of those capabilities as well. I concur. I think that data governance is a really critical area for businesses to focus on. Some of the capabilities could be data lakes, so how we bring data into the same place from disparate sources, and then actually investment in AI to help cleanse and interpret and actually transform data so that we can do something meaningful with it. And then on the other side of the coin is all around reporting. And I think the two key things there are selecting reporting platforms which help businesses to report against the frameworks that are materially important to them, such as CSRD, and also selecting platforms which really help your suppliers, those scope 3 emissions, your suppliers to really easily bring forward their information into your reporting. So they're two key things. And I was thinking also about some examples as well. And without naming the companies, we know we work with a very well-known large homeware retail business across the Benelux region, who are a leader in their field. And they, for a number of years, actually taken sustainability really seriously. I think something like since 2010, they've been heavily investing in it. And there's a number of platforms that they use for data management and also reporting. And that's really helped them to be successful in their field. And another business that we don't work with, but I'm super impressed by is a global packaging company for the fast moving consumer goods industry, operations in lots of different regions. And again, they've really heavily invested in people, in processes, and in the technology related to getting under the skin of the data. So collecting it, really being able to trust what they have and make really good, solid business decisions on the back of it. And because of that investment, which includes some really good reporting platforms, they're a leader in their field and really well known as a leader in the sustainability business community.
Thanks, Richard. And Julien, of course, as I said, Sweep is, of course, sustainability data management platform, and we're very proud of what we do. So from the work that you do with some of our customers, can you share some examples of how to leverage these digital tools and functionalities effectively?
Yes, sure. And first, I fully agree with Marie and Richard regarding all the, let's say, the expectations coming from the financial department. Today, it's not possible anymore to use only Excel to track, disclose all the extra financial and sustainability data. It's not feasible because, it's too complex to go inside the company through the different departments, the different entities, the different geo, and so on, to get all the data activity, to compute all the data activity into climate data, environmental data, etc. And as Marie said, at the end of the day, you need to get a kind of stamp from an auditor. So it means that all the data, they have to be auditable. And this is absolutely massive to have so many data, but to make it absolutely auditable. And as Richard said, at the end of the day, you have to, let's say, report under the GHG protocol, report under the SBTi request, report also under different regulation framework, CSRD, GRI, and so on. So the purpose is only collect once, but disclose everywhere. And for that, it's exactly what we are doing today at Sweep. You are able to collect once, and to disclose everywhere with the different framework, with auditable data end to end, which is absolutely essential. So having said that, after that, you've got a matter of scalability of the platform, capability of the platform, etc., etc. And it's very interesting. A few months ago, we carried out a study with one of our partners. You know, it's not a partner; it's independent companies. You know, the different analysts. And the purpose of the study was to analyze and to assess the return on investment based on the usage of a sustainable platform, and especially the usage of Sweep. And thanks to time saving because of the automation, thanks to cost reduction because of the different initiatives and decision makings you've done based on the data, thanks to cost reduction regarding consultant fees, audit fees, etc., etc., these independent companies did assess that by using Sweep, at the end of the day, you've got a ROI up to 238% over 3 years. It's absolutely amazing, to be honest. Even at Sweep, we discover how the ROI was high. So at the end, I think definitely it's a huge, let's say, move on the market today, especially from the financial department, moving from only financial data management platform to extra financial and sustainability data management platform. And we are at the beginning of this trend, but this is a mega trend.
Thanks, Julien. I think it's probably best if we move on to questions from the audience at this point, because we've run through our main topics really nicely there. Richard, I've got one for you first. Somebody asking about the biggest challenges in actually integrating technology for sustainability tracking and how finance teams can have a role in overcoming these challenges.
I think there's a few different elements to this, but actually one of which is the current IT landscape. So what have you currently got in play, and how can you incorporate that into any new investments that you make in terms of platforms? And I think one of the key things that the finance and sustainability team need to do really well is around stakeholder management, so that they can prove they can be leaders, they can bring people along the change journey in terms of helping them to understand the benefits of making new technology investments. And I think there's a piece around once you have the technology in place, it's then how are you going to really meaningfully benefit from it? And this needs to be thought about before, of course, that you make that investment. So what's the change process? How are you going to manage that? How will you navigate the stakeholders in the business over what time frame, and what sort of projects do you need in order to deliver that change?
Thanks, Richard. Now, got a question from Shane McCardles. Thank you, Shane, for your question. Shane's saying it's extremely difficult to get a baseline measure of projects so that we can later demonstrate ambitious reductions. Can anyone on the panel share examples of how to get that baseline set? Marie, is that something that you'd be able to answer?
Yeah, sure. I think just to reassure, I think it's a common issue. I think from a lot of different people, I think it's quite subjective on how we can even calculate a baseline. I think as long as there is a common methodology which is applied to all the projects, and then based on this assess in the same way for that reduction, this is probably how we would do. So it's not to over complexify the methodology, but have a methodology that is easily understandable by everybody, with the assumptions behind it actually accessible by people as well to understand how that's been built. And based on this is where we start calculating reduction. But at some point, it's just to have to go with something. We can't improve what we can't measure. And it's really important to have a baseline in any case and see that variation against that baseline is already a start in the right direction.
And maybe just to second Marie, what we can see, Shane, with our different projects is, as Marie said, I mean, the first baseline, I mean, for everyone, it could be a trouble, it could be complex, but it's not so difficult. What is very important, this is a dynamic, the trend. So to make sure that you will be able to make the comparison year per year regarding the evolution. And for that, you need to develop what we call the restatement, meaning that, for instance, a very concrete example, year 1, you've got your baseline. Year 2, you've got a new baseline due to the fact that you have some changes, either changes regarding the scope of the company or changes regarding the methodology you have used, etc., etc. And then you need to make a restatement of your baseline to be sure that what you are going to publish year 2 will be in a position to be compared to what you have published year 1, but with this restatement of the baseline. So don't be worried about the baseline. I mean, everyone has to face the situation. And at the end of the day, the most important point is to be able to compare your position year 2 compared to the one you've got year 1.
Thanks, Julien. Right, another question now. I think this is something that we hear quite often, to be honest. An anonymous questioner saying, I already have so many software platforms to deal with. I'm a little bit hesitant about integrating a new one specifically for sustainability, data and reporting. Is it really worth the time and effort of integrating a whole new platform, going through that process of training the colleagues? Whoever's asking this question, we do hear this and we feel your pain. Who on the panel might want to take this one up? Julien, you look like you want to answer this.
No, yeah, for sure. It's absolutely normal to question, and this question is very relevant. So far, when you are in a company, you are already using so many different platforms, especially financial one. The question of the sustainable platform, I think, is based on the fact that when you are speaking about sustainability, you have a part of customization. Meaning that when you're speaking about financial data, only financial data, everything is today absolutely clear. You know exactly all the regulation framework, you know exactly how you have to publish, you know exactly how you have to calculate, you know exactly, and whatever the scope of your company is, whatever the activity of your company is, you can use the platform you want, you just have to apply. When you are moving from the financial data to the sustainability and sustainable data, it's much more complex because you are speaking about your materiality, financial materiality, impact materiality. You are speaking about quantitative KPIs, but qualitative KPIs as well. You are speaking about the whole value chain, and could be totally different. It's not possible to make only 1 + 1 because you have some overlaps. You have to choose when you want to make the computing between activity data into climate data. You have to choose among a bunch of emission factors, which one is the most relevant for you. You have to make the comparison year to year, exactly what I said regarding the restatement, and everything, only some examples, but everything has to be customized regarding your own company. And today on the market, when you are asking, let's say, a financial data management platform to make this customization, it's not the core business of the financial data management platform. And so on the market, what you can see financial data management platform wanting to or willing to address the sustainability data, and in parallel you've got some sustainability data management platform with the willingness to address as well the financial data, and to improve the process and to improve the SLA and to improve etc., etc. But to me, at the end of the day, when you're speaking about sustainability data, you need to have this customization, and the customization is something very difficult, very difficult. It's a kind of knowledge. And today the sustainability data management data platform, they got it, and I think it's important.
Thanks, Julien. Richard, you look like you maybe wanted to bring us something else on that topic just before I go. No, you don't have to.
It's the challenge is, can I convince my colleagues that we need to invest in this in software platforms? You have regulation which is compelling businesses to report. So I would argue that there's a really compelling case actually to invest in platforms and specific platforms, because of course it's really difficult. There's complexity in reporting, which your own internal systems, which you may have adapted, would actually naturally find it quite difficult to be able to report against some of the nuances of those. So when you're looking for a platform, you want something that's going to be compliant and will be kept compliant by the software provider as things change, such as the effects of Omnibus on CSRD. You want something that enables really easy reporting against those frameworks, but also management reporting, so that you get the ability to investigate and see what you can do differently. And then I think the third really important thing when you're looking for a platform is you have something that really helps you around data management as well, because often those two, reporting and data, can be disconnected. But if you can bring them into the same platform, help with the challenges around data, I think that's a really, they're the three sort of components on making a good choice around platforms.
And just a second, Richard, I mean, when you're speaking about financial framework and financial regulation, you've got only one all over the world or something like that. When you are speaking about sustainability framework, sustainability regulation, you have different regulation, different framework, depending on the geo, and each regulation is moving a lot at the time being. The one example is the omnibus, but another example is what is happening currently within the US, etc., etc. So the one of the advantage of using a platform is to be sure that you collect once and you use it everywhere. So after that, you don't care about the kind of regulation you want to apply or you want to report under. You just have to collect once and you report everywhere.
That's the kind of thing that we love to hear, making people's lives a little bit simpler. I think we're at time, so I'm going to wrap up the webinar there. First of all, with a big thank you to our panel, Richard, Julien and Marie. Thank you so much for sharing your valuable time with us and our audience today. Thank you very much to the audience who's joined us live. And you will, of course, receive the replay of this webinar in your inboxes. So feel free to send that on to any colleagues who couldn't make it live today. You can also check out our website, sweep.net, for more resources. We have dedicated resources around all of these topics in English and also in French. And we have on there our events pages where you can see upcoming webinars and sign up for more webinars that might interest you. So yeah, thanks once again to everybody, and hope to see you again soon for another Sweep webinar. Thank you and bye-bye.